Jason, this is phenomenal, and not least because another private equity firm already tried to do this deal.
That's exactly right. I mean, this is, as you said, sort of the year of the big buyout so far, which candidly, people in the private equity world have been waiting for a long time. There is a massive amount of cash that has been sitting on the sidelines, measured in the trillions for big private equity firms, including Carlyle, which is out raising a big fund. So they need to put that money to work, and they need to put the money to work in pretty big chunks, just like this.
How has it become so easy for private equity to raise money, and maybe other types of investments are not raising that kind of money?
Well, the appetite is really there from a whole range of institutional investors and even individual investors to some extent. So you think about sovereign wealth funds, you think about the big pension funds, which have long been a real source of capital for private equity funds. You're starting to see family offices but get into it in a bigger and bigger way. And looking down the line, when you hear from David Rubenstein from Carlyle, when you hear from Steve Schwartzman and others, they are really tapping that retail market too. They're starting to draw a little more money there. The other side of this, obviously, you talked about the equity side in these big funds, but the financing is really there too for these big deals. And so that ultimately is what drives a big buyout market, is not just the equity, not just the cash, but the money that they're able to borrow from banks.
And what about targets? Because there can't be all that many targets that are ripe for the picking. I mean, clearly we found another one today. There probably are more out there, but when will it stop?
Well, we don't know when it will stop, and this is very much a cyclical business, right? In the sense that what you're seeing right now, and this is where private equity has really thrived in the past, is what's called a carve-out. And so you've got this company where they tried to do a merger, didn't work out, as you alluded to, for the whole company. And so they start to look at shaving off or carving out assets that they can sell to a financial buyer. Carlyle made its bones back in the early 90s, starting in the defense industry, of carving pieces out of a company. CD&R is another very well-known private equity firm that did this. And it's a really good business because they take unwanted, maybe for lack of a better term, divisions. They can clean them up a little bit and then either sell them or take them public separately. And it can be highly, highly lucrative for these guys.